Well, my first guest has laid out a great analysis of historical patterns after initial rate cuts, selecting 8 cycles that go back to 1982. Let's bring in BMO, their chief markets here.
Chief market something.
Yeah, I mean, you got so many titles, my man. Brian Belski. I don't even know why we use him anymore. Pretty simple. Just say Belski. Everyone knows Belski. So initial Fed cuts, right, and the market's performance thereafter. You chose, you went back to 1982. And this is great because you talk about the 12 months going into it, and then afterwards, 3 months, 12 months, and then 2 years out. What I thought was intriguing, though, you also have a line here, excluding tech bubble and the great financial crisis. Is this, so why do we exclude that? Because they were so extraordinary that they're not necessarily applicable right now?
There's a term in the math world, it's called spurious. I don't know what that means, but it's kind of an outlier. But if you take those two out, which were the really big negatives, and if you also take a look, especially 2007, you got to go back, that was the perfect storm where you have a credit recession meets a CapEx recession meets a consumer recession. That doesn't happen very often, okay? And so I think for us, when we take a look at history, I've said for 2 years that I think we're entering into this 1995-96 stock environment. I think that's the one to kind of watch. But if you go back to 1982, if you know your history, that's when people used to talk in Washington. So you had Reagan call Tip O'Neill over for a bottle of scotch, and then they had Volcker come over. Yeah. And they said, we need to get this, we need to get out of a double dip recession, and let's cut rates and cut spending, and and cut taxes. That's exactly what happened.
So 1982, 12 months after the first rate cut, up 36%, 2 years, 42%. Pretty good stuff here. Of course, again, these two you say outliers, don't necessarily 2001, 2007. These should not influence thinking right now.
Remember, we had the tech wreck in late 2000 to 2001, and then the Fed started cutting rates, and it was really only financials were the only game in town in 2001. But then we had, unfortunately, as we lived through the anniversary last week of 9/11, so a lot of that stuff was exacerbating the negative performance.
So I took your report, and we made a table out of the again. Looking 12 months out, for these things, with the notion of excluding the tech bubble and GFC, what these things have done, 12 months and 2 years. So here, it seems like, healthcare, 2 years later, was up 53%. Consumer staples, some of these things made mind-boggling moves. How is this influencing your positioning right now?
Well, the context of the sectors has changed a lot, especially within consumer staples. And you remember in 1995, we had the Nifty 50, and Greenspan's irrational exuberance speech was actually about Gillette and Procter & Gamble and Coke and Pepsi trading at 50 times. We lived through that together. I mean, I think the key thing for markets going forward is consumer discretionary, because consumer discretionary does very, very well into and out of a recession. If we think we're heading into a recession, which we don't, but the market has slowed down. But obviously technology and industrials as well, especially given where industrials have been kind of flat with the global growth not being great, but the more domestic side being better. So with the operating performance of industrials beginning to improve, I think that's an area for 2025. But tech still, given the fact of all these high multiples in the Mag 7, I think it's going to be coming back down into the next layer, the Palantirs, the Oracles, the AMDs of the world.
So, but the bottom line is that's a guide, and then you layer on what's going on right now today, because of course you didn't have the AI move and some of the other things. I want to give you a quick shout out. This is back in December, right? We like to wait 6 months or so before we bring back this is the ideas you gave us. Look at this, man. This is some amazing stuff. 38%, 39%, 31%, and just one down stock, and that's down less than 1%. So that brings us to what you're increasing your position on right now. You just mentioned Palantir. All of a sudden, everyone on Wall Street's loved this stock. I saw it fetch a $50 target recently. AMD seems to be the sort of but counter NVIDIA play right now.
So Palantir we bought about 9 months ago or a year ago, and we want to make sure our position's bigger there, especially as we kind of move away from only being in Mag 7. AMD, the semiconductors we've learned, and again, it reinforced that semiconductors are the most volatile earner in the S&P 500. So I'm still trying to figure out whether or not AMD is going to be to NVIDIA what Coke is to Pepsi. And so I don't know if that's going to necessarily be the case, but AMD with a great management team and great product. First Citizens is a sleepy bank. It's the former CIT, and it's a roll-up of all these banks. Amazing, amazing, amazing company. KB Homes, because of, I think we're going to build more houses, and interest rates coming down. And Fluor is this great industrial company that I think has been overlooked. And then lastly, Philip Morris. I mean, come on. You're talking about Altria, you're talking about a big dividend, consumer staples, more defensive, but not expensive. It's a true value stock.
And these stocks are just phenomenal. I mean, some people, shy away from them because, cigarette stocks, but just it's been amazing. I did not know that was the old CIT.
Oh, yeah.
Oh, boy. Good stuff,
Good old stock
man.
picking, man.
All right.